welcome back. Now I know I said I'll start with IAS 40 this video, but I lied. I realized that I only touched the surface of IAS 16, and since it's very important, I think I should take the topic a little bit more in depth. So that's what I'm going to be doing this video. So let's start. So let's look at depreciation. What depreciation is that it follows the accruals principle, and basically we're taking an expense, which is our asset, and we're spreading it across the life in which it gives use to us. So if it gives us 10 years of productivity, its usefulness is 10 years, and we're allocating that cost of the asset systematically over the periods in which it is useful. Now, our most famous methods of depreciation are straight line and reducing balance, and the main difference between them is that in straight line method, since we're reducing the same amount each year, we're assuming that the productivity decreases by the same amount each year. That's why we're reducing the same amount. Whereas if you look at reducing balance, it's usually a higher sum of depreciation in the first year. Right, so first year will be a higher sum, and then the sum will decrease in the second year, and then it'll decrease in the third year. So you're assuming that the asset's productivity is greatest in the first years or the initial stages, and then it gradually reduces. So that's the difference between the two methods, the concept behind it. And once you choose a method which is consistent with your asset, you have to be consistent in applying it throughout the years. Now, one of the elements of depreciation is its useful life, which means how many years are you going to use it for. So what they're saying is you have to review its useful life at least each financial year end, which means that if there is a change in useful life, you have to account for it prospectively, which means it's fine what you did till now, but after this, you will have to incorporate your changed useful life and depreciate machinery according to the new estimate. So let's look at a sum for this. This sum is given in the BPP textbook. So you acquire a non-current asset on 1st January 2012 for 80,000. It had no residual value, useful life 10 years. On January 2015, which is 3 years afterwards, the remaining useful life was revised to 4 years. What will be the depreciation charge for 2015? So first you need to find out the carrying value of the asset at 2015. So let's draw up a timeline. At 2015, you would have depreciated it for 3 years. So since it has a nil residual values, it's 80,000 divided by 10, which is 8,000 per year into 3, 24,000 for 3 years. This is your depreciation. So your carrying amount by the end of year 3 would be 80,000 minus depreciation of 24,000, which is 56,000. This 56,000 has to now be depreciated in 4 years, because right now your useful life is only 4. So that's 56,000 divided by 4, which is 14,000. So from year 2015 onwards, your depreciation charge per year will be 14,000, whilst compared to before where it was 8,000. So let's talk a little bit in depth about revaluation as well. We saw that the revaluation is a method of subsequent measurement where we keep it up to market value. And an increase in the value of an asset will be a revaluation surplus. It will go to the reserve. And a decrease is a revaluation loss, and we have to nullify the balance in the revaluation reserve, and then any excess will go to the debit of the profit and loss account. And if there is no revaluation surplus and there's only a revaluation loss, then you can directly take it to the profit and loss account. So we only saw a revaluation loss followed by a revaluation surplus. But what happens if there's a revaluation loss first and then there's a revaluation surplus? It is the exact opposite of what we looked at in the previous video. So we will first reverse anything that went to the profit and loss account, because there would have been a direct debit to your profit and loss account, and any excess amount we will put it in the revaluation reserve as a revaluation surplus. So let's take the example of machinery worth 100. So in the first year you were revaluing it to 95, it's a revaluation loss. So this loss would have gone to your profit and loss account because right now you don't have any reserve. It's just an expense. So you would have debited your profit and loss account with 5. A year after that, you're saying it is worth 110. So it has increased by 15. So first you have to reverse anything that you debited in your profit and loss account. So you will credit your profit and loss account with 5, and any excess, which is the remaining 10, would go to your revaluation surplus. Now remember that this revaluation surplus in the revaluation reserve will be shown on the equity section of the balance sheet as a reserve, and it will be shown on the OCI as a gain on revaluation. Now, since the OCI is made up of incomes which are not yet realized, what do we do when our revaluation becomes realized? First of all, when does it become realized? It becomes realized when we sell the asset and actual cash is received. That is what is being called as being realized. So when this happens, we take everything out of our revaluation reserve and give it to our retained earnings through something called a reserve transfer. And so the journal entry for this would be debit revaluation reserve and credit retained earnings. Now, why we do this transfer is because the revaluation reserve in essence is non-distributable. And by non-distributable, I mean that you cannot take the money out of it and give it as dividends. You can only give dividends from your retained earnings. So when you're transferring your revaluation reserve to your retained earnings, you are making that money distributable to your shareholders. You're saying, now I have received cash and now I can give it to my shareholders as dividend. Next, we'll see what to do when you have a depreciated asset which is then being revalued. So first you will have to reverse all your accumulated depreciation, and then you will have to bring up its carrying amount and then record a revaluation surplus in the OCI. So let's look at this example. It's from BPP. You buy an asset for $10,000 at the beginning of 2016, useful life of 5 years. On 1st January 2018, which is after 2 years, your asset is being revalued to $12,000. The expected useful life has remained unchanged, so which means that you still have 3 years left. So when you bought the asset for $10,000 and you say that it has a useful life of 5 years, you would have already depreciated it for 2 years, which is 10,000 divided by 5, which is 2,000 into 2. So 4,000 is already your accumulated depreciation. This would be present in your provision for depreciation account. So first you have to reverse this. Next, you have to bring up its carrying amount to 12,000. So it would have been shown in its asset account for 10,000. So you have to debit it with another 2,000. Your total revaluation surplus would be 10,000 minus 4,000 depreciation, so its value is at 6,000. Now you're increasing it to 12,000, so your total revaluation surplus will be 6,000. This will be shown in your OCI. So since your assets value is now 12,000, for the remaining 3 years, you will have to depreciate it based on 12,000, which will be 12,000 divided by 3, which is 4,000. So the year subsequent to 2018, your depreciation per year would be 4,000. So till now, it's pretty straightforward, right? Now next, because of your revaluation from 10,000 to 12,000, your depreciation charge has increased from 2,000 to 4,000, because before it was 10,000 divided by 5, now it's 12,000 divided by 3. Now this excess depreciation will be treated as being realized for each year. Remember what we do when a surplus is realized. We transfer it to the retained earnings, right? That is exactly what we're going to do over here. So each year we're going to transfer any excess depreciation because of our revaluation to the retained earnings. So your other comprehensive income will get debited by 2,000 and your retained earnings will get credited by 2,000 each year for 3 years. This will again be shown through your statement of changes in equity. Please notice that this transfer from your OCI to retained earnings is optional. You do not have to do this, but you may choose to. This will be stated clearly in your exam question paper if you are to do the transfer. Now, you might ask, why do we even have to transfer the OCI to the retained earnings every single year? Why can't we just let it be? Anyways, afterwards, when we sell the asset, everything in our revaluation reserve is ultimately going to come to the retained earnings. So why do we have to stress ourselves and transfer the excess depreciation every single year? Now, if you got this question in your head, I applaud you, because this was the same thing I was confused about when I was studying. So either we both ask the same good questions or we're both mildly dumb. Either way is welcome to the club. First, remember how our retained earnings are distributable, but our revaluation reserve is not. Now, your choice to revalue your asset upwards resulted in decreased profits for your shareholders, because when you're revaluating asset upwards, ultimately your depreciation charges are going to be higher. That's what we saw in this example, right? So your shareholders are indirectly taking a hit for that revaluation. So what you're doing is you're transferring a little bit of the consequence to the retained earnings every single year, so that their profits or their dividends will not take a hit. So once you transfer this to your retained earnings, that retained earnings will then become distributable, and so problem is solved. Now, the previous video we've only seen how to value an asset if you purchase it, but you can also self-construct the asset, which means that you are making it and you're building it up on your own. So what will be the value of the asset when you're doing that? You just add together all the purchase price of the labor or the raw materials that you have put inside that particular asset, so that will be your value. Next, you can exchange an asset for another asset, and here you will measure it at fair value. If you don't have a fair value, and we saw that the fair value can be substituted as the market value, so if you don't have a market value, you have to measure it at cost. And here the cost is the carrying amount of the asset given up. So let's go to derecognition. We would have seen this as the fourth phase of an asset. First one is recognition, initial measurement, subsequent measurement, and then we derecognition. So which talks about when we can take the asset off of our balance sheet. So when we can do this is if it is withdrawn from use, it is no longer of use to us, or if it's sold or scrapped, which ultimately means that no more future economic benefits are expected from this asset and from its disposal. Then this should be derecognized. Now, if you're selling it, you will get a gain or a loss. So basically, the carrying amount of which your asset is compared to what you are selling it for, or your net proceeds. If your carrying amount is higher than your net proceeds, it means that you have made a loss. Your value is more, but what you're getting is less. Likewise, the other way around, if your carrying amount is less and your net proceeds are more, it means that you have made a gain. This gain or loss will go to your profit and loss account as an income or an expense. So you have something called as disclosure, which is basically like a note to the people who are making use of your financial statement. And this will be present under or after your statement of financial position. This is just to let the users of the financial statements know if there's anything they should look out for, or any important information, that is. So for example, if you're an investor and there's a major piece of machinery for, let's say, 1 million, and you're saying, okay, this firm looks good, they have a lot of assets backed up, and if they had already pledged that machinery for a loan, then you should know that, because that will directly influence on deciding whether you want to invest in their business or not. Because if they can't pay back that loan, then that asset is going to go, and then it wouldn't seem like such a wise decision to invest in that particular business. This is exactly why the standard has some compulsory disclosures that you have to disclose to your users, and all of this is given in your textbook, so please go through that. So that's all for this video. Thank you so much for watching. So I'm not going to tell you what the next video is going to be because we all know how that turned out.